The average market rates are somewhere between 4.5 and low fives. So even if the Fed were to cut rates this week and the market is assigning a zero probability of that happening, it's not going to change that interest expense is going to continue to rise for the next year or two. If the Fed cut rates to zero, it might slow it down. But then the fear there is if you cut rates to zero and stimulate the economy, you wind up having even more inflation and you could wind up creating havoc in the bond market as well. So that is going to continue to go higher.
Hi, and welcome to Wealthy On. I'm James Conner, and today my guest is Jim Bianco of Bianco Research. And Jim and his team provide a wide range of research across many different asset classes, and we're going to get Jim's views on the markets as we head into the second half of the year. Jim, thank you very much for joining us today. How are things in Chicago?
Oh, things are great. It's summer in Chicago, one of the best places in the world to be.
Yes, I can't believe the last time we spoke was in January, so 6 months ago, and here we are, we're almost into the second half of the year.
Yeah, January, one of the worst places in the world to be is Chicago.
Well, I'm in Toronto, and it's not much different. So the last time we spoke in January, the S&P was at 4,600, and now it's at 5,300. Nvidia has added about $2 trillion in market cap, and Bitcoin's gone from 40,000 to about 70,000, give or take. And the Blackhawks didn't make the playoffs, I'm sorry to say. But how do you think things are now?
Yeah, I mean, other than the Blackhawks, which was not a surprise, the market did have a very strong first half of the year, but really what highlighted it is what you mentioned about Nvidia increasing its market cap by $2 trillion. And I might add, if you want to put that in perspective, Warren Buffett has been running Berkshire Hathaway for over 60 years, and Nvidia has created more value than Warren Buffett did in 60 years in 4 months. That's how extraordinary that rally is. Or if you want to put it in another way, the S&P is up about 12% year to date. Half of that is Nvidia. And if you were to add in some of the other Magnificent Seven stocks, you know, the Amazons, the Microsofts, the Alphabets, the Metas of the world, you know, a couple of others, you're at about 2/3 of the rally in the stock market is just a handful of stocks. It's been one of the most concentrated rallies ever. And I say one of the most concentrated rallies ever because there's no accepted statistic for what is a concentrated rally. You could actually make the case it is the most concentrated rally that we've ever seen in financial history, that diversification has been the least effective that it's ever been. So that has been really quite an extraordinary run that we've seen in the market right now. You strip out those 7 stocks and you're down around a 4 or 5% gain in the stock market for the first half of the year. The other thing I think that's been very interesting about what's happened in the first half of the year has been the rise in bond yields. I know it's hard to remember, but we started the year back in December at around 3.9% on the 10-year note. We got as high as 4.75 in April. And right now, as we're talking, we're at around, 4.45, 4.50. So there's been a big rise in yields as well. And that took a lot of people by surprise because back in January when we talked, everybody was bullish on bonds and everybody thought that yields were going to fall and they wound up doing something different.
And so having said all that, you were very bullish back in January. Are you still bullish on the markets now that the S&P is up 12% year to date?
You know, I'm a little less so because of those 2 reasons that I just brought up. First of all, because it's been a very concentrated rally. If you want to say, are you bullish on the market? Really, let's cut to the chase. Are you bullish on Nvidia? You can own the S&P, but really what you're doing is you're making you can own SPY or VOO, but really what you're doing is you're making a bet on Nvidia at this point. Are you really bullish on Nvidia? I am of mixed feeling about Nvidia. There's 2 things about that stock I'll just mention. Early on in any cycle, what you see is the hardware makers seem to do very well. If you remember back to the PC cycle in the 80s, it was IBM that was really roaring ahead. If you remember back to the early days of the internet in the late 90s, it was Cisco that was roaring ahead. And now it's Nvidia. It's the picks and shovels play, as we so often overuse on Wall Street, that no one knows what quite AI is going to do, but the people that are making the chips for it are winding up being that. I'll mention one quick word about Nvidia, and I'm not a semi-analyst or I'm not an Nvidia analyst. 7 customers are half their revenue. Even though they're they're a $3 trillion company, 7 customers are half their revenue. If you look at the, Tesla alone has bought over $1 billion worth of Nvidia chips this year. Their chip runs between $28,000 and $40,000, and Tesla's bought nearly 40,000 of them. AMD and Intel are sitting out there trying to innovate. And someday, if AMD and Intel come up and say to those 7 people, "Hey, we got the same thing, but it's only $10,000 and it's not $28,000 to $40,000," that dramatically and immediately changes Nvidia's business model. Now, their business model is a lot like Boeing is, where they basically got 2 customers or 3 customers, or a defense contractor. But those customers are pretty stable, and those customers aren't really looking to jump ship on them. But Nvidia, it might be a different story altogether. So I know I usually almost never go into stocks, and I went into that stock because it's half the rally, and that's what you need to understand when you start owning stocks. So I'm a little bit more sanguine on it, and the other reason I'm more sanguine on it is because of that rise of interest rates. What's been happening when you see the 10-year yield, when it gets above 450, and it's at 445 as we're talking right now, that seems to be a major headwind for the stock market, and it really seems to really struggle. The 10% correction last fall was when yields went to 5% above 450. The 6% correction in April is when yields went to 475 above 450. Those are the 2 biggest corrections since the bottom of the market in September of 22. Even 2 weeks ago, when yields pushed 470 briefly, the stock market really struggled as well. Now, why does the stock market struggle when rates go above 450? Because interest rates are looked at as competition. That's really what they're not looked at as slowing the economy or stimulating the economy. They're looked at as competition. Dr. Jeremy Siegel wrote a new update to his book, Stocks for the Long Run. In it, he said the long-term prospects for the stock market, just here, buy some stocks, any period. What should you reasonably expect without looking at the specifics of that period? About an 8% per year return. Okay, that sounds about right, about 8% a year. And that's historically what it's been, and that's what he thinks it will be in the future. When you start seeing the 10-year yield get about 4.5% and 3-month bills or money market rates staying above 5, I think a lot of investors look around and go, I could get half or 2/3 of the stock market's expected long-term return with almost no risk in the case of a money market fund because it's $1 NAV every day, or very little risk in case of a bond fund, especially compared to VOO or SPY. Good enough for me. I'll sign up for that. That's why I think the stock market struggles when it gets above 4.5, when the yields get above 4.5, because they're starting to look at it and going, people are just going to turn to their wealth managers and say, put me in some of those bond funds. I'll take 2/3 of the stock market's gains with 1/10 of the potential risk of the stock market. From a risk reward standpoint, that's a very good deal. So if yields continue to track higher, which I think they will in the second half of the year, we can talk about that, but I think it will provide a formidable, and I want to use this word carefully, headwind for the stock market. It's not going to kill the stock market. It's just going to be a headwind, and it's just going to make it a little bit tougher to continue to move forward. And of course, again, everything is all about Nvidia too.
Yeah, you made an interesting point about Nvidia and the concentration of it, because if you're an active portfolio manager or stock picker and you don't have a weight in that name or the other ones, you're significantly underperforming the S&P and the NASDAQ. You're going to have some very unhappy clients.
And it's understandable, because if you're a stock picker or a portfolio manager and you've gotten your CFA, and I don't mean this in any disparaging way, because I'd fall into the same trap too, and you do what we understand is how you're supposed to value companies. You look at the valuations of this company, and seven people are there, half their revenues, and those 7 people are looking for a cheaper alternative, desperately looking for a cheaper alternative. And then you conclude, yes, this needs to be far and away my biggest holding, and I need to be pressing this bet as hard as I can. No, very few active managers are going to say that. And that's why very few active managers have been outperforming in this rally. And that's the unfortunate reality about being an active manager. Now, the retort to that is, yeah, that's why you buy index funds. Until Nvidia turns and goes the other way. And then it's a boat anchor dragging the index down, where the active manager will wind up doing much better.
I'm really going to test your knowledge on Nvidia now. You made mention of the fact that 7 of their clients represent 50% of their revenues. Who would be the single largest client, and what percent of revenues would that client be?
Well, we don't know for sure who the largest is because they've only disclosed those kind of numbers, but it's believed to be Microsoft. And then after that, Alphabet, Tesla, as I've mentioned, Meta. Those are the biggest play. Those are perceived to be the biggest four, which is around 40-ish% of their revenue. Remember, you've got to buy these chips that are $28,000 to $40,000, right? And you're trying to put together large language models that we could look at. OpenAI, Anthropic are other big players that are buying NVIDIA chips as well. You and me aren't buying these chips. Regular Procter & Gamble isn't buying these chips. General Motors isn't buying these chips. It's these companies that are trying to make a big push into AI. And that's why AI is so concentrated in the big mega cap companies, because to say that we need to have artificial intelligence, it is really expensive. You have to spend hundreds of millions of dollars just to get the equipment in place before you start training the models. And then you need specialized, coders and specialized people in AI. And there's already stories now that, kids that are graduating from college with these degrees are in such great demand. They're getting $500,000 before graduation day just because they know how to do this stuff. So it is unbelievably expensive in order to do this. And this is why it's all concentrated in those top companies. So that said, Nvidia doesn't tell us who is the breakdown, but Tesla has. Tesla has told us that they've bought 35,000 of their chips. And if you do the math at about $30,000, 35,000, that's $1 billion. They have spent $1 billion. Now, how much of that is X for Gronk, their AI, a large language model, and how much of it is for Tesla and self-driving is not clear, but they have bought a lot of it.
So let's talk about the economy now. We recently saw a revision of Q1 GDP, 1.3% down from 1.6, and that's down from about 3% last year. And I want to get your views on the economy. And do you think it's slowing? And do you think the next print we see is going to be 1% or lower?
So the answer to your, let me give you the answer is yes, the economy is slowing. And the reason I think it is slowing is because prior to the first quarter, if you look at all of 24, you had several quarters of very strong growth, above 2.5% for most of those quarters, if not above 3. Now, let me back up. Economists have a concept called potential growth. And what that is what should the U.S. economy grow at if no one is stimulating it or no one is trying to restrain it? Now, that's not an observable number, but they guess that it's around 2 to 2.5%. So we had several quarters of potential growth or more than potential growth. In the first quarter, it looks like we had below potential growth at 1.3%. Now, that's not unusual, a couple of quarters above, a couple of quarters below. Second quarter. The second quarter looked like in April, it started off weak. You were down at around 1.6% on the Atlanta Fed GDP now. That is, the Atlanta Fed does a GDP tracker that takes all the data that goes into the GDP report for the second quarter and then says, what is the run rate of the of GDP for this quarter? Now, think of that like the marathon. You take your 10-mile time and then you project what you would run for the next 16 miles, and there's your finishing time. Well, that assumes you're going to run at the same pace. You might speed up or you might slow down. And in the case of the economy, you might revise the first 10 miles as well. But that was running at around 1.6% through the end of April. And now that we're into June, it's up to 3.1. So it's looking like April was a weak month, but May, the economy has been rebounding quite smartly, headlined by the bigger than expected jobs creation of 272,000 jobs for the May payroll report, which was issued last week. So the economy is running a little bit slower after several quarters of faster, and it seems to be picking up. Now, let me make one other quick comment, because usually when we talk about the economy, people talk about, we're going to have a recession. And my answer is no, we're not going to have a recession for a very simple reason. There was an MIT economist named Rudy Dornbush, and he famously said, I think in the 70s, that economic expansions do not die of old age, they're murdered. Now, what does he mean by that? You'll hear, and I've been reading just this week, well, is the economy rolling over? The answer is economies don't roll over. That's not how it works. In a capitalist economy, everybody that's listening to this podcast is looking to put their money with good ideas and looking to take their money away from bad ideas. So, all things being equal, you should expect the economy to grow around its potential. So, a couple of quarters, we had several quarters above in 23, have a little bit of a period below, in early 24, maybe starting to rebound into the summer, maybe. But that's to be expected. Well, what causes a recession? A murder. What's a murder? A COVID shutdown of the entire economy, a spike to $150 in crude oil in July of 2008, a housing market crash in 2007, 9/11, a tech market bubble peak, Arab oil embargo, Saddam or Iraq, which was headed by Saddam Hussein, invading Kuwait in 1990. These are the type of murders that cause a recession. So yes, the economy seems to be slowing after a period of stronger growth, but I don't think it's at risk of recession because there isn't a murder out there. And the murder isn't people stop spending their money. The murder isn't that, we stop buying cars or something or we stop hiring people. We do that in reaction to a pandemic shutdown or an invasion of another country that spikes crude oil through the roof or a geopolitical crisis. These are the types of things that cause recessions. So yeah, we're in a period of a little bit below potential growth after several quarters of above potential growth. And that's really all I see it as being right now.
Interesting comment. So I want to get your thoughts on inflation now. Continues to be very sticky. And a lot of this has to do with the massive fiscal spending we're seeing by the federal government. And I want to discuss this too. But before we do that, I want to ask you about stagflation. And I'm reading a lot about this lately. Do you think stagflation is a possibility here in the coming months?
Oh, the dreaded S word, stagflation. Yes. The problem with stagflation is what is the definition of it, right? Stagflation is supposed to mean that you get slower growth and higher inflation at the same time. Now, typically, growth is a driver of inflation. When the economy is going along very strongly, that creates economic activity. People buy things, they push up prices. When the economy slows quite a bit, or it goes into recession because it's murdered, people stop buying things and prices fall. Stagflation is the economy slows, but prices continue to move higher. So to the specific definition of stagflation, are we seeing it? I would argue, yes, we are seeing it because we're seeing the economy slow and we're seeing inflation pick up. But when I say that, people, their heart skips a beat because they think stagflation means the late 1970s. It means the economy is crushed by near recessionary type of slowing of growth and 100-year high in inflation. Well, that's an extreme form of stagflation, but that doesn't mean that that's the only definition of stagflation. So if you ask me clinically, yeah, we're seeing slowing growth and we're seeing a little bit higher inflation, and that would qualify as stagflation, but nothing at all like what we saw in the late 1970s and maybe into the early 1980s. That brings along the other question you brought about. What about inflation? I've been of the opinion that the inflationary cycle that we were used to of 2% or lower inflation year in and year out, that ended in 2020 with the pandemic. That we're in a new cycle of higher inflation, persistent inflation, 3% to 4% inflation, not 2% inflation. And why are we in that persistent era? I think three things. I think, first of all, the deglobalization trend is only accelerating. And maybe it probably started after the financial crisis of 2009, got accelerated with the Trump tariffs of 2018. But one of the few things that the Biden administration's done that has been an extension of what the Trump administration has done has been to seem put up more barriers to globalization. So whether or not Trump or Biden wins doesn't matter. Globalization, hammering China, trying to protect American jobs is going to be the norm going forward. That is going to raise costs because it's more expensive to do things here than it is to do things other places. Now you could argue it's come at a heavy toll because it's gutted whole industries because they've moved overseas. I understand that argument. But deglobalization is one reason you're going to see higher inflation. The other thing I think you're going to see is just a complete mindset change. I know the Fed talks about inflation maintaining its being well anchored, and I will violently push back on that. No, it's not. It is not well anchored. People have become accustomed to the idea that prices go up and that they're used to prices going up. And that's why the president's approval rating is down. And that's why cutting through everything, if you ask in all the political polls, what is the number one issue that people are going to vote for in the United States in November? And the answer is inflation. It is overwhelmingly inflation, immigration being second on that list as well. So that is going to definitely see a pushback as well, too. And third, and this gets to stories that we're seeing this week, oil and energy is being used as a political weapon, and that is going to keep the price elevated. That we might have found a bottom on the price of oil in the mid 70s, not in the 40s or 30s like we were used to prior to 2020. And you add all that up, and I think we are going to stay into a period of stickier inflation. And that doesn't even get to remote work and wage inflation. Remote work is changing the nature of work, and that is creating, I think, more wage inflation. So we are in an inflationary period, a sticky, persistent inflationary period. Now, why did I go through all that? Because if you ask most economists, they don't think that the cycle changed in 2020. They're all thinking that we're in the last mile to 2% inflation. And I don't think that that's been the case at all for 4 years. This was kind of the way it was in the early to mid 80s. As late as 1985, the typical economic forecast was we were going to return to 14 or 15% inflation. Although it peaked in 1980, it took them 5 years to realize that that cycle changed as well, too. We're 4 years into this. Maybe in another year, they'll start to realize that we're in a different, inflationary cycle of higher inflation. And the last thing about inflation, what I didn't say was 8, 10 Zimbabwe inflation. I didn't say that. I said 3 to 4% inflation. Well, why is that important? Because it gets back to a comment I said earlier. 4.5% in the 10-year note. And the stock market starts to struggle because it's competition. Well, if we're in a 3 to 4% inflation world, then the neutral funds rate, or the rate that the Fed might think is neutral, is no longer 2.5% or 2.75%, but it might be closer to 4 to 5. And that 4.5 10-year note might be closer to fair value, and get used to 4.5, 5-ish interest rates, that is kind of standard fare for where we're going to be moving forward. And that option of I could get over half of the stock market's gains with much less stock market risk of those bigger interest rates are going to be with us for a long period of time. And we need to start to adjust expectations for that, largely because if we're going to have that persistent inflation at 3 to 4%, that is going to keep it up there.
God, I hope you're wrong about this persistent inflation, because these prices are killing me. But another
They're
element,
killing everybody. If I could just jump in real quick, there was a study put out by a bunch of Harvard economists, and I don't want to butcher their names, but it came out last month. It was featured by Justin Lahart in the Wall Street Journal yesterday. And they pointed out that most people view a 1% rise of inflation as twice as injurious to the economy as a 1% rise in the unemployment rate. Meaning, if you gave the average person an option of should the unemployment rate go up 1% or should inflation go up 1%, they'll say the unemployment rate going up 1% is far less injurious to the economy. And one of the things they talked about when you talked about these price rises is they said it puts constant stress on 100% of the population because prices are squeezing 100% of the population. And that's why it is such it's corrosive effect on the economy. In other words, the public is almost saying, look, 1.7 million people need to lose their jobs to go from 4% to 5% inflation. 4% to 5% unemployment. 1.7 million people lose their jobs. But 300 million people are suffering under 3 to 4% inflation. If you could take the unemployment rate to 5% and bring the inflation rate down, do it, is what they seem to be arguing. Do it. It's much less stressful on society. And I'm not suggesting that they're saying consign 1.7 million people to unemployment. We forget how bad inflation is for an economy, how much it just wreaks havoc on an economy. And we're so cavalier about when's the Fed going to cut rates? How many times is the Fed going to cut rates? Oh, yeah, we're in the last mile to 2%. Don't worry about it. It's all going to be no problem. The inflation rate's going to return back to where it was pre-2019. And all of that is to just paper over how much pain and suffering inflation does cause an economy.
Yeah, so true. The other element we got to touch on too is government spending, and the Biden administration is just spending billions and trillions of dollars as if they're a bunch of drunken sailors. But the federal debt level now, $35 trillion. It's growing by $1 trillion every 100 days, which is a staggering number. Debt to GDP now is 125%. We haven't seen a number like that in decades. The deficit now is $1.7 trillion or 5.5% of GDP. And what are your thoughts on this? And does this concern you at all? And how does it get resolved?
You know, I chuckled when you said the federal government's spending billions and trillions of dollars, and I was thinking to myself, I wish they were spending billions. That would be actually a big improvement, because they're spending $6 trillion a year. Now, to put that number in perspective, that's 22% of the U.S. economy. That is a fifth of the U.S. economy. Now, we are a Keynesian type of mentality when it comes to federal spending. What does that mean? When the economy turns down, when we go into recession, we expect the government to spend like crazy to stimulate the economy out of recession. Okay, fine. But then the other half of that equation is when we get out of recession, we expect the government to back off and not continue to spend as much in the recovery. We didn't do this cycle. We continued to spend this cycle as if we're in recession. 22% of GDP is federal government spending. Other than COVID and the financial crisis, which you saw a little bit higher numbers, every other recession in the last 50 years, when we were in the worst of the recession, the government was never spending 22% of GDP. So that is one of the reasons, another reason why I think we're not going to have a recession. You just can't have a recession, defined as negative GDP when the government is spending that kind of money. It will single-handedly keep the economy moving forward. It will single-handedly keep pressure on prices and keep inflation to continue to be sticky or persistent in that 3 to 4% range. So I think that is going to be a problem. And by the way, I don't think that gets solved at the ballot box. There isn't a Hamilton or Jefferson 2.0 that is sitting out there that is going to come in and say, look, this is unsustainable, which I think it is, and we have to rein this in, which I think we need to. There isn't. If Trump comes in, he's going to cut taxes. Look, I'm all for tax cuts. I'm not against them. But if he winds up being like Reagan and he winds up cutting taxes, but he doesn't rein in spending, he just blows the deficit out wider just by cutting taxes. If Biden wins, it's just, full steam ahead on even more spending. He'll threaten to raise taxes, but he won't do it. And then we'll just have a wider budget deficit. So what ends this? What ends this is what we saw, which is now being referred to as the Liz Truss moment. In the fall of 2022, 2 years ago, Liz Truss was the Prime Minister of the UK. She put out the mini budget, cut taxes, increase spending, widen the deficit. Parliament, their Congress said, fine, we'll vote for this, no problem. But the gilt market, their bond market, said, nope, we can't do this. This is unsustainable. The 30-year gilt yield rose 140 basis points or 1.4% in 1 week in September of 22, 2 years ago. The Bank of England has 300 years of data. It's never risen that much in 1 week. It rose 45 basis points one day. It's never risen that much in 1 day, and they've got 300 years of data. It created a financial crisis. It forced the government to stop with all of the spending. And it wound up causing Liz Truss to resign as the Prime Minister of the UK after 47 days. And the only thing on her resume in those 47 days was the Queen died. She'll forever be a trivia question. Who was the Prime Minister when the Queen died? And so that's how you wind up ending something like this, is the financial markets say, you're done. And we're going to take interest rates up because I don't want to own your bonds because you're issuing too many. And then the government says, but these are important programs. But what about spending for the poor? And rates go up and up and up. And then they break something. Liability-driven investing was what they broke in the UK. And they create a financial crisis and they force spending to rein in. That is a dark scenario. I admit it is a dark scenario. But now that I've said that, when does that happen? Is it later this year? Or is it in 15 years? Or is it anywhere in between? I don't know. I don't know when it happens. I'm not going to opine on when I think it's going to happen, but it could be many, many years into the future, or it could be many months into the future. But what I am trying to argue is, do not think that there is people on the ballot that are going to say, look, we can't continue to raise debt at $1 trillion every 100 days. We have to stop this. They'll say it. They'll be sincere about it, but we won't stop it. Because spending is power in Washington and no one wants to voluntarily give up their power. And if the bond market wants to stay at 4.5% or 5%, or maybe even rally back to 4%, if I'm wrong about sticky rates, then the argument is, see, the bond market's fine with us raising $1 trillion every 100 days. Keep doing it until the bond market says, you're done, stop. And like I said, I don't know when that will be, but that's probably the only way, that Liz Truss moment, that you're going to wind up seeing this end. But like I said, I wouldn't be surprised if it's not in the next couple of years, that it's several years away. Doesn't have to be weeks or months away. It could be. But this is the type of danger the federal government is playing with all of this massive spending. I'd like to be wrong, and that I'd like to think that in November, coming out of November, that we will have a new priority on spending. But I just don't see how we're going to have a new priority on spending, and that we're going to voluntarily stop this before it gets out of hand.
Yeah, doing so would be political suicide, especially going into an election. But my other question to you is, do you think Liz Truss actually has that 47-day stint on her resume, or does she just leave that off?
No, she's got it on the resume. And the joke is, not to get into geopolitical, but, the National Front Party did very well in France. And then Macron called snap elections for the end of the month. And he's in trouble. He might be out, in a matter of a couple of weeks. And the joke was he should call Liz Truss to talk to her about, when things turn against you, you could go in very, very fast and be out. And so, yeah, she's on a rehabilitation tour, and maybe be counseling other European leaders about how fast you can wind up being out of office if you do the wrong thing, like she did.
So we got to talk about the interest expense associated with these debt levels, okay? And I believe in 2023 it was just over 800 billion. In 2024 we're going to spend over $1 trillion on interest, and that number's are only going to increase. And I read in one of your research notes that the average interest rate on the government debt is 3.23%. And that number is only going to increase when they go to refinance it, okay? It's going to be done at maybe 4%, maybe 5%. And so this burden of paying interest is just going to increase as time goes on. And I want to get your views now on interest rates, because the Fed is really backed into a corner. They want to cut rates, right? Especially, given this onerous interest expense that will be coming up here in the coming year. But what do you think the Fed's going to do with interest rates?
So on the first part of your question, you're right. The average interest rate that the federal government is paying is about 3.23, called 3.25%. But as I mentioned, the average market rates are somewhere between 4.5 and low fives. So even if the Fed were to cut rates this week, and the market is assigning a zero probability of that happening, it's not going to change. That interest expense is going to continue to rise for the next year or two. If the Fed cut rates to zero, it might slow it down. But then the fear there is, if you cut rates to zero and stimulate the economy, you wind up having even more inflation, and you could wind up creating havoc in the bond market as well. So that is going to continue to go higher, and it's going to continue to go higher. Now, as far as the Fed goes, there is a big push by Federal Reserve officials to cut interest rates. They have said all year that they expect that they're going to cut interest rates this year. Back in January, we were pricing in 6 or 7 rate cuts for the whole year. That hasn't come to pass. We haven't gotten any, and it looks like they're not going to cut rates at the June meeting. The July meeting is probably around 10% probability they're going to cut rates at that meeting. I would put the odds at least that, if not lower, because that's between the Republican and the Democrat convention. And if the Fed really wants to get political, go ahead and start a rate cut cycle between the Republican and Democrat convention. We'll stop talking about whether or not Donald Trump goes to jail or whether or not Joe Biden has the cognitive ability to have a second term, and we'll start talking about Jay Powell. And that's the last thing Jay Powell wants to do, is insert himself in the middle of those two debates. And that's what would happen if he winds up cutting rates in July. So I think July's off the table. So that gives you September, 7 weeks before the election. Same argument. Do you want to overshadow the election by making yourself the issue for cutting rates? So we're looking at, earliest we're looking at is the end of the year, November, December, that they could cut rates. But why haven't they done it yet? Because all of the assumptions that the Fed has said about why we're going to cut rates is they expected inflation on its last mile to 2%. They expected the economy to slow. Now, we've seen some of that in the first part of the year, but we might be seeing it turn around and speed up. And we're not seeing inflation really cooperate. We're still at 3.4% year over year CPI, where you're still at 2.8% year over year core PCE. That's the Fed's favorite measure of inflation. These numbers are way too high for the Fed to be considering cutting rates. So simply put, why isn't the Fed cut rates yet? Is because the data is not giving them the room they need. It is not there yet to give them the sufficient amount of either economic weakness or inflation weakness or both to cut rates. They're not there. The politics are getting in the way in the next couple of meetings. So maybe the economy slows down enough that they could potentially pull off a rate cut in November or December. I personally think it won't. I'll go back to my 22% number with the federal government. They are spending so much money that the economy isn't going to slow and inflation isn't going to slow, and it's not going to give them room to cut rates. And maybe that comes as a problem for the stock market. Remember what I said, when you go above 4.5%, it's a headwind for the stock market because it's just, a good deal from a competition standpoint for your investment dollar. But this is really where I think we're going to see is that if we see the economy even slow, if I'm wrong and we see the economy slow, leaving out maybe there's a murder. And I mean, a murder would be some geopolitical event. And then you look, there's $120 crude oil or some other geopolitical event that creates other kind of stress points in the global economy that changes that equation. If that happens, happy to come on and talk about it, but it hasn't happened yet. But if we were to see, if we don't see that, I just don't see how the economy with this level of government spending slows, and that just keeps interest rates up, and that keeps the Fed forever talking about their desire to cut rates, but not getting the actual excuse to do it.
Okay, so you said the Fed wants to cut but it can't because of the level of inflation, but we recently saw the ECB cut rates, and they said they did so even though inflation is not near their target rate. What are your thoughts on that, and why did they go ahead and cut rates?
Well, the two things is that we have seen in the past, we have seen this decoupling between what the European Central Bank, the ECB, does and what the Federal Reserve does. Famously, Jean-Claude Trichet, who was the head of the European Central Bank back in 2010, raised rates. He thought that the financial crisis was over and that they had to worry about inflation, and he rose rates. Now, of course, we know that the Federal Reserve under Ben Bernanke held rates steady at zero from 2009 to 2015 during that period. So the first point is it's not unprecedented that you see a divergence between the European Central Bank and what the Federal Reserve does. Now that I've said that, why did they cut rates? Look at the growth rates in Europe. You could argue that they are in recession right now, that you've seen consecutive contracting GDP quarters in the UK. You've seen zero GDP numbers in Germany and for the whole of the European Union. Their economy is far, far weaker than the US economy is. And so they're looking at, in some of their countries, they've got much, much higher, unemployment rates, approaching 9% in Spain with some of the unemployment rates. So they're in a far different cycle than the U.S. is. So I understand why they cut rates, and then you throw into that Rudy Dornbush line that economies don't die of old age; they're murdered. The European economies might be getting murdered right now through political upheaval. And what you've seen with, the weekend before, we've seen elections in Germany and elections in France where the right leaning anti immigration parties just trounced the left leaning current parties in power. The prime minister of Belgium resigned on Sunday. There is an epic swing towards the right in Europe. Now, I'm not arguing whether that's right or wrong. I mean, whether that's a good thing or a bad thing that Europe is moving towards the right, but it is unexpected and it will create upheaval. Just like if they had a big unexpected swing to the left, it would do the same thing as well. So they've got upheaval on top of a weak economy. So they're in a far different position than the US is. So I understand why they cut rates. We'll just have to see whether or not they wind up, stoking inflation on the European continent because they're trying to stimulate their economies as well.
Interesting comments. I hope we get the same sort of movement in Canada as they're seeing in Europe right now. But that's another conversation for another time. We started
You're
this
seeing that movement everywhere in the world, including the United States, including New Zealand, including Australia. That is this worldwide movement towards the right is everywhere except maybe the UK, where it looks like Rishi Sunak and the Tory party is going to probably give way to Labour. But that's because the right has been in power in the UK where they weren't anywhere else in the world.
So we started this conversation talking about Nvidia and the move that it's seen just in the last 6 months. It's gone from 1 trillion in market cap to 3 trillion now, which is just extraordinary. And I want to get your views on speculation and the level of speculation we're seeing now. I think it's on par with what we saw in the late 1990s. And when I look at the hype surrounding AI, cryptocurrencies, NFTs, you probably forgot about those, but the metaverse and these meme stocks. I don't know if you watched Roaring Kitty last week, but
I did.
It's back, or he's back. But what are your thoughts on this level of speculation we're seeing now, and does this concern you?
It does concern me, but let me back up. This is not surprising in one respect. We are a gambling culture. Look at what we do right now. Online gaming is exploding in popularity if the government will allow it to happen. Otherwise, everybody's doing it overseas through a VPN. We have seen a massive explosion in, gambling on sporting events. The leagues have embraced it. It has raised the value not only of their franchises, whether you own a major league sports team, but also if you watch sports television in the United States, half the shows are about betting. How do I position my fantasy football league, or who do I take this week in my fantasy baseball league? That's what all the TV shows are about. They're not about breaking down the games anymore. No, I went through that because we are a gambling culture. So why should we be surprised that gambling is showing up in 0 days to expiration options? Over half of the options that are traded in the United States expire today at 4 o'clock Eastern. 0 days to expiration. We trade daily options. Half the volume is in that stuff. Meme stocks are going ballistic as well. Cryptocurrencies, altcoins, otherwise known as shitcoins, are going ballistic. So I'm not surprised by the gambling that we're seeing in the United States. And yes, we should expect it to, reverberate into, the financial markets as well. That brings up, what's different now is there's a centralized marshaling force behind all this. Fancy words for saying social media. Sure, we had gambling culture in the late 90s, but you didn't have the Reddit boards and you didn't have X to basically, start narratives and get everybody to say, yes, we all got to get into GameStop, or yes, we all got to rush into Bitcoin or something like that. We were all doing that independent of each other, not being able to communicate as a group. So that's what we're seeing in this economy. And quite frankly, the regulators are really struggling about it. You mentioned Roaring Kitty, Keith Gill. He put out, he came back 2 weeks ago where he put out a meme, a picture where it was a guy with a game controller leaning forward. And in the gaming community, that is the meme for this is about to get interesting. And the Wall Street Journal was asking, should the SEC be investigating him? And the answer was he put a picture on put a picture, on his Instagram and on his X account. That's all he did was he put a picture. Everybody interpreted it as being such. But welcome to 2024, where a lot of our regulatory rules look, like prehistoric right now for the type of world we're in. And maybe we don't want to be censoring people for putting pictures on the internet by saying that that is some form of securities fraud. That is a dangerous, slippery slope to be going down. So it's a whole brand new world. So yeah, I'm not surprised by it. And yeah, I am worried about it because typically, the word for it is degen. Degen is short for degenerate gambling. The Wall Street Journal had a big story about how degenerate gambling is really exploding in popularity. And I always remembered that, when it comes to degenerate gambling, there's only two types of degenerate gamblers: those that have lost all of their money and those that will lose all of their money. And if you're a degenerate gambler and you haven't lost all your money, keep at it and you will. And that's the problem with gambling like this. Now you could argue, societal impact and everything else, and it is concerning. But I don't know if you could really, or nor do you really want the government to be heavy-handed in breaking down all of this gambling. But right now we are a gambling culture, and it is showing up in not only sports, but in our culture, and it's showing up in our financial markets. And it's an unfortunate reality, and it isn't going to go away anytime soon.
Well, that was a fascinating discussion, Jim. I always enjoy speaking with you. And as we wrap up, if someone would like to learn more about you and the various services that you and your firm offer, where can they go?
So, two services. We do offer a research service under biancoresearch.com. You could look us up there, or you can follow me on the socials at Bianco Research on YouTube. We have an active YouTube page, or at Bianco Research on X or Twitter, or follow me under Jim Bianco on LinkedIn. The other service we offer is we do manage an index, which is actively managed fixed income index, and there's an ETF, WTBN. Wisdom Tree is our partner. So Wisdom Tree, Bianco, Nancy, WTBN. And you can find out more about that at biancoadvisors.com, which tells you about how we do an actively managed fixed income fund, or index, and that there's a tracker fund that follows it. Think, S&P manages the S&P 500, and VU and SPY track the S&P 500. We're set up very similar.
Once again, Jim, thank you.
Thank you.
Well, I hope you enjoyed that discussion with Jim Bianco, and it provided you with some insights on what to expect in the coming months. If you're trying to figure out how to prepare for your financial future, consider having a discussion with a Wealthion-endorsed financial advisor at wealthion.com. After providing some basic information, Wealthion will put you in touch with a vetted advisor. There's no obligation whatsoever to work with any of these advisors. It's a free service that Wealthion offers to all of its viewers. Don't forget to subscribe to our channel, wealthion.com, and also hit that notification button to be kept up to date on upcoming events. If you have any suggestions on who else you would like to see on our channel, please let me know in the comments section below. I would love to hear from you. Once again, thank you.